Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, and this is another great episode of this podcast. I'm happy to announce that this is the first episode of 2023, in fact, so excited to begin this new year. And for this, I have an amazing guest. This is going to be someone that I've been looking forward to have on the show. He had me on his podcast, had an amazing time, and each time we've spoken, we've had a great time together. Good laughs, and it's going to be no different this time. It's Mike Milan, and Mike, aka Cash Flow Mike, is basically how he's known. I've basically been able to emphasize that he is an expert in strategic planning, finance, and sales, gained over 20 years of diverse professional experience. In that time, he's developed 14 startups into well-established businesses and earned the nickname Cash Flow Mike. So that's something that I think everyone could aspire to have, is a nickname like that. Now, Mike is an Army veteran and has an MBA from Baylor University. He's also known for 2 books that he's authored, The 7-Minute Conversation and Don't Be a Dumb Business Owner. Now, he's focused on a number of things, but he's also created a financial management training program called The Clear Path to Cash, the 8 steps to maximizing cash in any given business situation. He's also created several fintech software products like Cashflow Tool, Finagraph, and Path by Simplex. Mike has also co-hosted a podcast, one called Nobody Told Me. He does that with Blaine, where they focus on topics and lessons that they can learn by being an entrepreneur. And currently, Mike is in the business financial space. He's a specialist behind the brand Cashflow Mike, where he has a lot of things that he does to help business owners and accountants get, grow, and keep the cash that they make in their business. So, Mike, welcome to the show.
You know what? I couldn't have wrote that better myself.
No, you couldn't have. One of the things I always say is, hey, that sounds like a nice guy.
Yeah, that's right. But I tell you, what a great year it's been. I mean, I met you in person, I think in San Diego. Isn't that what we determined? So San Diego.
Yeah, that's when we met. Yep.
And in one short year, I am the first guest in 2023. 1 year. Look at that.
That's right. And in less than 1 year, I've been on your show. We've had a variety of conversations. A lot can happen. It can go quick. Hey,
even flowers grow in the concrete, right?
Flowers or weeds, whichever you'd prefer. Yeah. So I'm going to start with a few things. Obviously, Cashflow Mike. I don't know why I want to bring this up, but I'm going to say it anyways. There's that show where it's the dancer. Do you know what I'm referring to?
No.
Oh, okay. No,
yeah, I do, but I have a different skill.
I know. That's what I was going to say. So tell me, how did you get Cashflow Mike?
It's really funny. I mean, and I'll tell you, it all comes back to one moment that changed my life. And it goes back to my very first business I started that, I opened a hotel staffing company and had 27 offices in 9 states in 3 years, about 500 employees. I mean, it was super fast growth. But if you're like me, Roger, if you've ever lied in bed, awake at night, wondering if you could pay payroll or pay your bills or, how you were going to open the next office or keep growing. Well, that's the cash flow issue that actually changed my life. Was I maxed out the credit cards, I took out a home equity line, and I was out of options. It was, get a line of credit, which I was already pushing my line of credit, or beg the hotels to pay me faster. So that's what I end up doing, right? Is learning a cash flow lesson about bringing money faster in, and I call it the speed of cash, coming into your business faster. So I started preaching that over and over and over again to everybody I met. I talked about it, to bankers at Chamber of Commerce's. Anybody would listen. I started preaching cash flow over profit. And because of that, they started calling me Cashflow Mike. So I guess I was just one of those parrots that just kept talking all the time, same words.
Well, I think it's an admirable thing to be discussing, and it's for a few reasons. One, that analogy of staying awake at night, wondering how you're going to make cash flow. Honestly, when they use the phrase, it's lonely at the top, I think that's an emotional thing that business owners uniquely experience, that unless you're an owner of a business and you've maybe mortgaged your home or something to the effect of being able to make the cash flow, it's just a feeling, it's an emotion, it's an anxiety that many people just don't experience. And you're right, it all stems from this cash flow situation.
Well, what's funny is that my first job before I got into business was as a state trooper, right? And then I'm sitting there writing the student loan check, for this MBA, and I'm like, oh, what am I doing? Why am I still fighting crime when I could be out there actually making some money? But the stress I had as a trooper was nothing compared to what I had, running my first business.
Yeah, I appreciate that analogy because I know that that's very stressful as a trooper. Just walking up on a vehicle is stressful enough, but the owner having to leverage, let's say, the mortgage, as I mentioned, it's just an interesting sacrifice that the owner goes through as they try to keep the business alive, and it all comes down to cash flow. And I've got one other illustration to give, and I'd love your thoughts on it. I remember being in a meeting where they were talking about in Congress, they were talking about how businesses could be profitable but cash poor and even go bankrupt even when they're showing that they're being profitable. In other words, they've got customers that are buying their product, but because of their terms, it's very possible that the company is having to make payroll, having to take care of the cost of goods, whatever the case may be, where the client has received the product or service but hasn't paid yet. Maybe they've just either taken advantage of the net terms given or they just have delayed payment. And yet the company is left holding the bag and needs to make all this payroll, and it stems down to cash flow. The company's profitable in every respect, but from a cash perspective, it's struggling. What do you have to say about that?
Dude, what a great point. And I've got to tell you, there's about 50,000 business bankruptcies a year. 35% of them had net profit, just like you described, which means they're making money. How come they can't pay their bills? And it's a phenomenon that's called growing broke, right? You actually outrun your own operation. Have you heard of that before?
Yes, I have. I've experienced it. So yes.
Yeah, it means sometimes it's your dream to get your product, we'll say, on a Walmart shelf or a Target shelf. But that dream can become a nightmare really fast because, well, it happened to a guy I know, Alden Mills. He built a product called the Body Rev. Right? You might not know the Body Rev, but after he ran through about $1.2 million in that initial angel financing from friends, family, and pools,
yeah,
he actually was down to his last, we'll say, $100,000, and he pivoted the product and he changed it from the Body Rev to a product we all know called the Perfect Push-Up. Right?
Okay.
So that's kind of the evolution of that product. So when he changed the product from the Body Rev to the Perfect Push-Up, his sales went from $0 to $2 million the first year, then $60 million the second year. So he was living the dream, right? He had his product on the shelves, orders are coming in, but all the meantime, he gets an order from Target. He pays the distributor, the raw materials, his payroll, his rent, everything like that, over and over and over again. And I don't know if you've ever done business with a retailer, but when they sell 100,000 units in the first week, they're going to order more the next week, right? And even more than that the week after that. So he's got 5 or 6 orders lined up where he's owed hundreds of thousands of dollars on Perfect Push-Ups. Money's going out the door in payroll, raw materials and supplies, and he hasn't got paid yet.
Yep.
He almost lost the company that second year because he couldn't keep up with fulfilling the orders. So it's exactly what you just described, and I'm glad you brought that up.
Well, thank you, because I think business owners, when they turn to us as accounting professionals, this is what they're looking for help with, is how far can they extend themselves and what can they be forecasting and expecting as they grow, where capital's needed and where can they go to get that capital, lines of credit, investors. All of these things are things that we can be contributing to as accounting professionals to help them foresee these cash crunches, these cash situations before they arise. This shouldn't have caught us off guard as we project this kind of growth, and we can be helping in these things. Wouldn't you agree?
I do agree. And one of the things that bankers know that accountants generally don't, which I'm hoping we can help educate on, is there's a concept called the financial gap. Which means it's a cash conversion cycle. And I teach a course called the Fast Money Formula. But this financial gap is the amount of time where your business is waiting for money to come in while you've paid all your bills or money's already went out. And there's a difference in that time. Now, the amount of money you should have in the bank, your working capital or access to, should be enough to cover that financial gap. So before you go get a loan, before you start asking the banker about a loan, we should understand what the financial gap is, and are there any things that we can do to the conversion cycle to shorten the gap? Because just like a gap you jump over in the sidewalk, you want it to be small, right?
Yeah.
You don't want to jump over a large one. So the larger the financial gap you have in your business, the more money it takes to run your business. So your goal is to have a small financial gap because it takes less money to keep you running smoothly.
Yeah, it's like riding a train. You got to mind the gap. You've got to pay attention to when you're
Yeah.
stepping from the platform onto the train. And one of the things that I think is helpful here, and it's something that we address in the book Red to Black, is how important it is to understand and know what's going on with accounts payable versus accounts receivable. And it's literally, as you're describing it with cash flow, it's understanding how much that money is sitting in your hand before you're paying someone else. And I think too often, as accounting professionals, we're not getting involved enough in the payables receivables relationship to help the client actually delay paying some of the bills that they have, is extending with their vendors some of the net terms that they have today, getting better ones, and improving how their customers are paying on the front end, maybe paying up front a percentage before getting the product or service. Afterwards, the payments, what net terms that they may be on, staying on top of the collections. There's a lot that can be done to manage cash flow. So let's talk about your book. I know you've got a book. You chose the word dumb to be part of the book title. I mean, obviously it says, don't be a dumb business owner. Why dumb? And what are you talking about in there?
Well, I mean, first of all, I meant it to be funny, and it might be aggressive to some people, and I apologize, but it's not that. It's a way to have you understand that you don't understand your business. Dumb means don't understand my business. So what? And I'll tell you, I was dumb right? Early on. I didn't understand my business, so that's where I came up with the words, dumb, to be able to determine that. So yeah, that's where it came from. But I think it's funny.
Well, first of all, knowing you, I know you think it's funny, and it is funny. I will admit it's funny. I love that it's an acronym. I mean, being from the Army, I have to assume that stemmed from that. And by the way, thank you for your service, and I genuinely mean that. That is phenomenal. Just the other day, we had Veterans Day, so we're recording this here in November. Thank you for your service. Genuinely, I love our servicemen and women, so thank you. But dumb, it's an acronym. And I think that's important to realize that as business owners, it's, I think, a great description of many business owners. Is that fair?
Yeah. And it's not meant to say unintelligent. It just means, there's levels of competency, right? I mean, at any given time on any given subject, we're either unconscious incompetent or consciously competent, right?
Yep.
Somewhere on that spectrum. And even though, in my experience, they're great at what they do. They can run great restaurants. They can run great auto body repair shops. But when it comes to being financially sophisticated, they're dumb, right? Not because they're unintelligent, it's because they haven't focused on that part of their business yet.
Yep. So just this week, I was meeting with one of our clients. I'm a business coach for many business owners, and I was meeting with them. We were doing a retreat, planning for the year. And as part of this meeting, we covered a variety of things. And when it was all said and done, at the end of the meeting, we were just standing around talking, and we were reflecting on our starting 2 years prior, the working relationship that we have. And in that conversation, they shared the feelings they had as they first began speaking with me. And the wife, it's a husband and wife team that run the company. The wife specifically remembered when she took the first phone call from me. She was referred, and I answered the phone. I have this booming voice, and she regretted the moment I answered the phone just because my voice was so intimidating to her, saying, "We cannot meet with this guy. This is not going to go well." So they come in and meet, and what they shared with me is the fact that when we were initially speaking, they were so anxious in those first meetings because they felt that I was going to ask them questions that was going to reveal they didn't know as much about their business as they thought they should. And they were worried that I was going to intentionally put them in a corner and make them feel, for lack of a word, dumb about their business. And of course, I didn't do that. And within a few months, they felt safe and they started to realize that they do know more about their business than they realized. but oftentimes it was also the questions that I asked them that caused them to dive deeper into their business, have intellectual conversations and thoughts about their company that they had never had before. And it stimulated them to now feel confident and smart about their business. So what you're describing is something I've experienced many a times with the business owners I work with. So I think, although dumb can be very harsh, I think it's an accurate depiction of what I think a lot of business owners experience. Does that make sense?
Yeah, that's super interesting. So let me ask you this. What are some ways for, because I think this is important for a lot of like advisors or coaches, what are some ways for them uh, to help ease their clients so they can open up? What are some techniques or, something that you use or a principle that you use that helps someone open up faster?
Love it. Love it. The first thing is genuine curiosity. I just go back to being a kid again, and I just want to ask a whole bunch of questions about why did they start the business? What do they do? Why is it unique? Why is it special? What excites them about the business? It's just that genuine curiosity of, you've got this company. I mean, this is so cool. Tell me about it. And if I'm able to do this in person, it's take me on a tour, show me around. And it's just, tell me about this, tell me about this. And it's like a kid in a candy store. I'm just kind of curious. So that genuine curiosity is the first thing. The second thing is I just want them to talk about their journey, share with me their story. What caused them to want to start their business, or how did they get into the position of owning the company? I want to hear that story, because typically with that comes the emotion. It comes these, and almost every story has this element of I didn't know or I didn't expect. There's this moment in time when something unexpected happens. And I want to hear about that. And they'll tell me, yeah, I didn't anticipate this. I didn't expect this, but we did this. And I love that part of the story, because that's when they start to liven up. When I've done those two things, been genuinely curious and asked them to share their story, I have found that the person starts to realize that I care. And as they realize that I care, that I'm being non-judgmental, I'm just interested in them, they will start to reveal more and more. And as it happens over a few of the initial visits, that allows them to then feel that they're in a safe zone. That's what I need to first have the rapport necessary to go deep, which will come later in my working relationship with them. Does that make sense?
Yeah, I love it. I tell you, every time I talk to business owners or actually bankers and accountants specifically, I always ask them, what business do you think you're really in? And to me, I think you're in the dream fulfillment business, right? If you're working with clients, this business owner has a dream. He started this business for a reason, or he wants to do something next. Your job is to help him get there, to fulfill his dream.
Yep. I agree. Totally agree. So I'm going to change and go to, where's it you got this great idea for your signature program, the clear path to cash? I mean, your cash flow, Mike. What's this clear path to cash?
Another interesting story. It was born out of desperation.
Okay. As typically is the mother of most inventions, right?
Well, yeah. I mean, so when we built Finograph, we're talking 2012 now. We built a product that was designed to help bankers have better conversations with business owners. And in order to get in the door, in order to get their attention, we got to provide value. So I created a training program that told my side of the story, which means, bankers, in 2008 had already left the small business space with the introduction of Dodd-Frank, a lot of regulations. It cost them just as much money and time to do a $5,000 loan as it did a $5 million loan, right? So most of them moved up market just because that's where the dollars were. That's where the invention of like Cabbage and On Deck and, Lending Club and all these other marketplace lenders came in, is because bankers had left the small business space. So in order to get banks' attention in 2012, they were trying to come back downstream, right, to capture some of the market that Cabbage and On Deck had taken, or what's another than SoFi now, right? We built this training program to go in and teach bankers how to talk to me, the small business owner. That at that time I had 10 small businesses underneath my belt. So I'm like, if you want to get my attention, if you want to make me more bankable or more lendable, here's the way I have to hear your story. You can't use words like, leverage and solvency and, liquidity. You've got to be able to talk to me at my language, at my level. So it was about translating banker language into blue collar language, if that makes sense.
So when you do this, obviously it's from a banker's point of view. How does it relate or correlate with the accountant?
Well, that's part of the triangle, right? I mean, it used to be bankers, accountants, and attorneys. They were all on the pedestal with the small business owner, right? They were all there. And what I learned over the last 25 years is that my banker and my accountant give me advice, but usually it's the opposite advice, right? One's telling me to do one thing, one's telling me another. So what you have to do as a business owner is be able to discern who's right at the right time. And this is where I got involved with accountants, because I'm like going, okay, well, they're only focused on a tax strategy, and you pay tax on income. So their goal is to reduce your net income so you have less tax. Well, net income, becomes retained earnings or equity on the balance sheet, which is where the banker focuses, right, on the balance sheet, because they can lend against your equity. That's where the ratio of debt to equity comes from. So if I'm reducing, net income, I'm also reducing my ability to borrow. So it's like going, okay, how do I get the banker and the accountant to help the business owner make the right decision at the right time? And that's, part of how I brought accountants into this, into training and helping them give better advice on how to work with the banker better. And the first module I built was how to deal with your banker.
So where do you, I like this idea of the two having different, let's say, agendas. I want to elaborate on this a little bit more.
Yeah, sure.
So the banker is obviously interested in basically extending loans, and the loans you're determining based on certain numbers, but they're also interested in the deposits, the money that's in the bank, and that gives them, as a banking industry, the leverage that they can then, at a 9 multiple, obviously lend out more money. So what we're talking about here is that's their agenda. The accountant, we're obviously interested in helping at best get net profit, get everything down to the bottom to where we're actually showing a good ROI and, more importantly, a good margin return. So how are we now getting those two to work together?
Well, I mean, basically it's understanding EBITDA, right?
Good.
It all comes right down to EBITDA, which is, if earnings before interest, taxes, depreciation, amortization. But in general, it's just a proxy or a substitute word for cash flow, right? That's where EBITDA comes into play, because the calculation itself puts everybody on a level playing field, because it takes out the effects of financing decision or accounting decisions. What I mean by that is some of us get equity financing, some of us get debt financing. So if I take out or add interest back in, I make both players equal. Same thing with depreciation and amortization. You might use straight line, where I've used double declining. By adding back in depreciation and amortization, outside of it being non-cash, it doesn't matter what technique you use, we're all level. And it gives everyone a true picture of what cash flow really is. So what I've tried to do is we've set up sponsored programs with banks, and we invite accountants in. So now you've got bankers, accountants, and business owners all in the same room. And if banks are out there doing it, they get Community Reinvestment Act credit for financial education. But those three players in the same room learning the same concepts has been magical for what happens in a community. And I mean, Hills Bank in Iowa is a classic example of that.
This is perfect. So one, I'm going to ask for the classic example, just to elaborate on it, but I want to draw attention to the EBITDA statement. There are some numbers that I think are very important that, as accounting professionals, we should be bringing our clients, and we need to educate them as to what these numbers are and why we're watching them. Obviously, net income. Is there a profit? Are we actually making money? But in addition to that, it's your return on assets, your return on equity, and then EBITDA. If we bring those numbers to our clients on a monthly basis, quarterly basis, yearly basis, we're watching some very telling numbers of how the business is doing. And so that net income, return on assets, return on equity, EBITDA, these numbers are hugely important as to what the business owner is doing with their company. Are they making the right decisions? And each of those numbers we can prioritize and say, we're going to work on this one next and make decisions within the organization that impacts that specific number, because there are certain things you can do to manipulate, change, affect those numbers individually. So give us the case study example that you were alluding to.
All right, so Hills Bank in Iowa, 14 counties around Cedar Rapids, right? I think their headquarters is in Cedar Rapids, and I've been working with them for, I don't know, 7, 8, 9 years now. And what we've seen is an increase in their commercial deposits and their small business banking, where they are the small business bank of Iowa. They pride themselves in a technique called relationship banking, which is connecting, all the advisors or all the parts of a business around them. They're like a quarterback for a small business, right? It makes sense. Meaning they take all of the power of the bank, all of the stuff that they can do in the bank, and put it in front of the business owner where they can use it. But then they're connecting that with the right people, the accountants, the attorneys, other advisors in the community. And what's happened, not only have they grown to being the largest small business banking or bank in Iowa, their lending has come up over 200% in that time period, which means they're lending out more money than ever before. When everybody's saying banks have left the space, they're actually showing just the opposite.
So I'm really an advocate for building a relationship with a banking institution for what you just described, but I'm going to add to it. The way a bank makes money, a large way, is lending, as you're describing. And so when you go into the commercial lending department and talk to those loan officers, what you'll oftentimes find is that they more often turn businesses down and don't issue the lines of credit or the business loans that they're looking for because of the lack of the accounting numbers. And so by definition, they're actually needing accounting professionals to step into these businesses, get their accounting in order, and by doing their books, get to a point where they have the documentation, the history in the numbers to give to the bank to then justify the lending, the business loan. The complementary thing to that is having a proper pro forma, actually forecasting out and doing estimates of, if we grow, we're going to need this capital, and avoiding the cash flow situations that we were talking about in the very beginning, because they proactively were walking into the bank and saying, we're going to be doing this product launch, we're going to be doing this product development, we're going to be opening up this new space, we need this capital to do this, and here's how we can justify the money, simply because here's where the revenue is going to come in later on. That is where this symbiotic relationship between the banking institution and the accounting profession helps the business owner. How does that sound?
I think it's exactly right, because, you need that network around you. As an accountant, you need a banker or two or three, that actually helps you understand what they're looking for. So when they grab that pile of papers from you for a loan application, and they go behind a closed curtain for 2 weeks and come back and say no, well, you should have known that before you actually turn the papers in. So what I'm trying to do is give people the answers to the banking test. What is it that they're looking for? Where should your client be? And how much should they ask for? These are things that bankers don't typically train on. And I don't know why, right? Outside of the fact that they think they're scared of a thing called lender liability, which means they can't give you advice on how to run your business. They can only interpret what it is. So that's where the accountant really works hand in hand with the banker, is because they can give that advice.
Yes. There's a report that we use, and I don't know if this is something that you're familiar with. It's called benchmarking. It is used by the banking industries. And for a number of years, we provided to a number of banking institutions, small business associations, basically this report called BizBench, where in addition to the executive summary, it gave specific information such as the liquidity ratios, the financing ratios that banking institutions, credit unions would use to assess the viability of the business to determine a loan. And like you just described, when a business owner knows this information before going in, if they know these ratios, they'll know before they even apply whether or not they're going to get the loan. So we've conversely taken BizBench and given this as a report to business owners, to accounting professionals to provide to their clients so that they can proactively do the report, and in doing so, have in front of them the numbers they need with the suggestions the report provides as to what they can do to put themselves in a position to get the lines of credit you're describing. So, yeah, what you're talking about is hugely important. So, I'm curious, you train and teach all of this. What makes your training different?
Well, the training is different because of the way that I communicate the concepts, meaning that, just being a farm kid from Illinois and a Texan now, being able to take the language of banking and convert it to the language of the business owner, right? And I think that's where I've been best at it. I don't use words like solvency and leverage and all that. I actually teach the task and the purpose, which is when we do this ratio, here's what it means and why we need it. I'll give you an example. Most people know current ratio, and the benchmark for that is 2 or higher, right? But if you ask, but if you ask most people, well, what does that mean? They can't tell you. What is that? So to me, the current ratio is just: do you produce enough money in your business to just stay in business, to just support yourself? And so I put everything to the Shane test, and Shane's my best friend, and he runs a painting company up in Tacoma, Washington.
Okay.
If I can't explain a ratio or something to him, then it doesn't pass the Shane test, right? So to me, when I talk to him about the current ratio, he knows nothing about it. I give him examples. The formula is pretty simple, right? Current assets divided by current liabilities.
There you go. Yep.
So let me give you an example of a current asset, Shane. It's your checking account. Let me give you an example of a current liability. It's your credit card. So if you divide your banking account by your credit card balance, it comes up with a number, and we'll say that number is 2. Well, if you see a 2, that means for every dollar you owe on the credit card, you got 2 in the bank. He starts to get it when I talk to him like that. And what I teach accountants to do, and don't be a dumb business owner, is how to have that conversation. What are ways that you can describe this to a business owner who doesn't have the financial awareness that you do?
I love that. You're right. Current ratio, that's one of the biggest things that we emphasize with our clients, because you're right. Taking that balance sheet and making it useful is huge. Many of the clients I work with, when you initially start working with them, they don't understand the purpose of or the need for the balance sheet. And yet that ratio right there is exactly where it comes from. And in order to say you have the monies, the means to pay the bills that you owe, is a big deal. And that actually eliminates a lot of the stresses and anxieties of running the business, just to have enough of that asset available, liquid asset, to pay the bills, the obligations you have that are short term. So your example, the Shane test, is perfect.
Well, I appreciate that. Thanks. It's one of those things that, you want to be able. The other thing I don't like is I have my accountant. He always says, oh, you're 7% this, or you're 10% down here. I don't use percentages when I'm talking with my clients anymore. I use dollars, because I don't know how much a gallon of milk costs in percent, but I do in dollars, right?
Okay.
I call it the financial impact. So if you're going to tell me that we're down 10%, is that $100? Is that $1 million? So don't make me do an additional math step to understand what you're telling me. So one of the ways that you can communicate better with your clients is just convert what you're trying to say to dollars, because if you want to motivate change, behavioral change of the business owner, you want him to execute on an idea that you have, give him the financial impact of that.
Wow. I have to agree with you. Sometimes when you bring in the information, it's overwhelming and they don't know what it means until you put it into dollars and cents. And all of a sudden, when they realize that you're talking about, hundreds, thousands, tens of thousands, hundreds of thousands, millions of dollars, now it's starting to, really hit where they matter. And one of the things I would add to that is you need to understand how the business owner likes to receive information. Some it's data points, some it's graphs. And it's just, visually, how do they want to actually receive that information? And I like your point being dollars. Just tell me what this means in dollars. I'm losing or making how much because of this. So that's good. I'm curious. There's a lot of misconceptions in a lot of the work that we do. What's one of the misconceptions that's pretty common in your opinion as it relates to financial management or advisory services, as, for example, accounting professionals work with their clients?
There's been this big rush to grow advisory services. And what I'm noticing when I'm talking with, my clients that actually are accountants is that there is a lack of confidence, right? Because there's no clear process. Nobody has a real good structure on how to price it, how to execute it. So that leads to a lack of confidence in what you're doing, because everyone's so busy doing their own thing right now. To build an entire new structure around an additional offering is overwhelming to some, right? I mean, some of the big firms already got it figured out, but some of the smaller 10-man shops need a process. So, with education and with structure, you get confidence. So that's one of the misconceptions that I think already that business owners believe that process already exists, that your accountant already has all this knowledge and already has these services in place. So I think that's one of the misconceptions. The other one is they think that if they give advice, the business owner doesn't execute. So there's a gap between what the customer expects, the business owner expects, and what the accountant's providing because it's not changing behavior in some clients. So to me, I think that process and changing the way you speak and what you motivate people with, meaning dollars, is a good way to either instill confidence in both sides and change behavior.
Related to this, you're reminding me of something that I've experienced, and it's an opinion. I mean, it is my opinion, but it is just an opinion, and it's my distaste for the word partner. I've seen so many times accounting professionals use the word partner with their clients. I partner with my clients. And in talking to business owners, I actually found that term was a turnoff. It was actually something that they were really afraid of and would run from, because as accounting professionals would say that they partner with their clients, it implied two things that many of the business owners they didn't express, but they felt, which is one, I don't need somebody coming in here to tell me how to run my business. I don't need a partner. And at the same time, it also was implying that there was some way or a path to equity, that I'm going to help you run your business. Therefore, I want something for it. And when I heard this, and I was hearing business owners kind of shy away from anyone that was saying that they were wanting to partner with them, I really started to say, okay, what is the better term that would best reflect the relationship as an accounting professional that I could use to help them realize what I'm doing? And there's a variety of things that we've taught over the years. We definitely emphasize that of becoming a profit and growth expert. It's more it's inquisitive. What does that mean? But the same thing, becoming a strategic advisor or a strategic coach is something that has resonated very, very well. But as you were describing what you were saying, that experience came to mind. So I don't know if you have any experience or thoughts on that.
Well, I'm always surprised at why we need a new label. Why can't you just be my accountant?
Well, I'll tell you why. In the accounting space, there is, for business owners, this preconceived notion of what an accountant is. And oftentimes as accounting professionals, when we talk to business owners, they say, I've already got one, I'm already doing it. And it doesn't allow us as a profession to really get into a conversation with the client as to what it is we can do for them that they're perhaps not receiving right now. And so I know a lot of people, whether they're bookkeepers, accountants, CPAs, they look for some other way to introduce what they do for their clients other than simply saying accountant, because it then, in my opinion, is very similar to Charlie Brown. The moment you say that you're an accountant, the business owner then hears the adult going wah wah wah. Everything you say after that just is incoherent. So when you say you're a profit and growth expert, it's like, well, that's interesting. What does that mean? I've not heard that before. Or that's interesting. That's not what my accountant does for me. And it just causes for some great conversations that I've been able to participate in, simply because they didn't just hear that label and shut down simply because they thought they knew what it represented or defined. And honestly, this is a totally different topic, but I think there's a great need in the accounting profession for us to better explain the services we offer the 6 things that we do are oftentimes not clearly understood by the business owners simply because they think everyone does everything. Not every bookkeeper does tax, for example. Not every accountant does tax planning. There's a lot of things that people do and don't do in the accounting profession, yet the business owner presumes we do everything. So there's a lot to be said about that.
Yeah, I don't disagree with you. I just think the industry itself created that perception, right? Meaning that business owners already believe that you're the expert. They already, trust you for your advice.
Yeah.
They have to then discern when I'm talking to, accountant A versus bookkeeper B, what you can do and what you can't do. Right. So it's kind of an interesting dilemma that the industry's in, is shifting beliefs of of the business owner ecosystem on what they already think an accountant is and what they can do,
Yeah.
they're capable of.
Great point, because I know a lot of business owners presume that they have to work with a CPA when obviously that's not the case. I know that a lot of people that are outside of the accounting profession presume that when tax season comes, every accountant is working 80-hour weeks, but there's many a bookkeeper accountant that don't do taxes, and they're at home watching television while the tax preparer is frantically trying to meet the April 15th deadline. So it's just nuances. Obviously, it's education. I agree. I think some of this has been self-imposed as an accounting profession, but nonetheless, it's our jobs as we work with business owners to educate them as to what it is we can do with them, because there is a unique difference between bookkeeping, accounting, tax planning, tax preparation services, CFO, advisory or business coaching services. There are 6 unique, very distinct services being offered there, and every accounting firm gets to decide of those 6 which they're going to provide to their clients and which they are not. So that's definitely a big thing. And this whole thing of cash flow really is in that circle of accounting. It's not bookkeeping, it's not tax planning, it's not tax preparation, it's cash flow. And actually, I take that back. It could be part of a tax planning strategy as to how much cash you're holding on to for liquidity. But that brings me to another question I want to ask you. Really, how much money should a business have in their business? You brought up current ratio earlier, but let's put it in dollars and cents. You said that. So what is that?
Yeah. All right. So if I'm advising you, Roger, I mean, and I don't know much more about you than I know right now about your business, I always tell people to have at least 3 to 6 months operating expense kind of in reserve, kind of in hold. Bill Gates used to keep a year's worth of salaries in reserve. Right. I know we're not all Bill Gates, but that was kind of his threshold. That's how he looked at it, was whatever I have, he says, because I didn't want a mistake I made to impact my employees. I wanted to be able to at least pay them for a year and work out of a mistake. So if I'm talking to you, 3 to 6 months, and why do I say that? Because if there's a natural disaster like these hurricanes, it usually takes 9 to 12 months to get out of it. Sometimes if you have seasonality in your business might last 1 to 3 months. 3 to 6 months helps you ward off any really potential threats that you might have in your business. So if you're spending $10,000 a month in operating expense, you should have $30,000 to $60,000 available.
I love it. I love your answer, because honestly, that's the peace of mind that I think a lot of business owners need. And really, when you have that kind of reserve, it does allow you to make some business decisions that allow you to take advantage of opportunities as they present themselves, hire key people that become available. There's a lot of things that it allows you to do when you're not living in a strapped, operating expense payment to an operating expense payment just because cash flow is so tight. So very good advice. I like that. Let's do this. I'm going to flip now on the personal side. I know that you and Blaine have this podcast. It's quite interesting. It's based upon the concept of each of you having a beer, 2 guys with a beer chatting. Tell me, how did that come about, and why the beer? What's come of that?
All right. So first of all, Blaine and I used to be competitors, right? He built a program called Dry Run, which is a direct competitor to Cashflow Tool. And believe it or not, in the world, even though you compete, in business, you still might like somebody, right? So we would get together and just talk, just chat. And generally we'd have a beer, and he lives in Canada part of the year and Scottsdale part of the year. I live here in Texas. And it started out as just having a conversation. And much like you and I have done, I really liked the little bit of banter there. It's like I would have went down the rabbit hole of trusted advisor and why that's a cringy title now. we could have really expanded on that whole topic, but that's what happened to he and I. We could take any single topic and just talk about it. And we're like going, this might make for an interesting, entertainment value for someone else. And so we decided to put together a podcast and just talk for about 50 minutes to an hour. And we pick a topic. And generally, we don't know the topic until about 3 to 5 minutes before. And what's interesting is that he and I can expand on a topic for an hour, just knowing what the topic is and stay on topic. So the beer is about two guys that like to talk to each other and have a beer, but we relate the topic back to real life experiences that we've had. The title of the show is Nobody Told Me with Mike and Blaine. And these are things that we learn that you can't learn unless you sit in an owner's chair, right? You can't learn it at an MBA in Baylor. And we'll say, nobody told me how hard it'd be to name your company, like was a topic. And just think about how difficult that is to get all the social media handles, to make it match, to get the people to understand what you're trying to do. So it's about two guys that like to talk to each other, and occasionally we have an awesome guest.
Occasionally.
We've already had one.
Oh, brother.
But actually what's happening now is people are asking to come on. So you might have started something.
There you go. Good. Tell me, why did you move to Texas?
I fell in love.
Yeah,
but it comes right down to it, so I had a personal life change, a few years back, and I met the most wonderful person in an airport. So not Tinder, not classified ads, not the grocery store, in an airport. And we dated for a year, 1,800 miles apart. And in 1 year, we saw 17 states and 3 countries together. And I thought, man, if I can do that and travel and just really love to be around that person, I want to be closer to her. So I moved to Texas.
All right. So in an airport, what's the go-to pickup line then?
Hi, I'm Mike. I'm not clever enough to do anything better.
Oh, brother. Okay. All right. So pickup line. Hi, I'm Mike. Here we go.
Yeah, you should use that one, though. Because you're starting off on a bad foot.
No. I won't use that one. However, I am going to do this with the names since we're talking names. I have a clever way of introducing what my name is and how it's pronounced. Everyone sees my name, Knecht, and they're wondering how to pronounce it. Is the K silent or not? They'll come up with variations of different sorts. And so I always explain, it's very simple. It's simply like connect the dots, connect the dots. And that right there just alleviates that concern. They know how to pronounce the name. You have a similar thing I found when asking about your last name, how to pronounce it. How do you do it again?
Well, if you've ever heard the song, This Land Is Your Land, well, you know the second part of that. This land is my land.
My land. There you go. I love it. So, Mike, having you on the show, this has been amazing. What I'm going to do is I'm going to just kind of summarize some of the things that we've discussed and then come back to you for a closing thought. In doing this, I just want to point out that there are a few quick offers here for our listeners that I'd love to encourage you to take advantage of. You just need to go to the episode description, and in the episode description, you'll find there the information on how you can receive a free download, a digital copy of Mike's book, The 7-Minute Conversation, from his website, cashflowmike.com. And with that, you can definitely take advantage of that opportunity to get that free download. In addition, he also has a Facebook group that he's inviting you to join, that the information and link will be in the episode description so that you can go there and participate in some of the conversations that are occurring there in the Facebook group. In addition, because of our conversation today, I also want to encourage you to get a copy of Red to Black. This is a free copy of the book for accounting professionals. It's the how-to guide to actually help you take a business and quickly turn them around, taking them from being in the red to being in the black. In fact, being that profit and growth expert that we were talking about earlier, it is the book to help address the principal problem that many businesses face, which is exactly what we've been talking about today, cash flow. So go there, find out more information about that. And lastly, BizBench. We were speaking earlier about this relationship that accounting professionals can have with banking institutions and helping their clients actually, before going in and asking for the money, knowing better what it is that they would qualify for and whether or not they'll even get the loans that they need. And an excellent tool to help you actually do this is BizBench. BizBench is a benchmarking software using the NAICS code to actually compare that business to its industry standards. And in doing so, identify all the key ratios that they need to know, from current ratio, liquidity ratios, to the ones that we were mentioning earlier, such as the return on assets, return on equity, EBITDA, all based upon what is called the DuPont model. Definitely worth looking into and taking advantage of as an accounting professional. It's an additional service that you can provide to your clients and be paid handsomely for doing. So with that being said, I've loved our conversation today. Obviously, Mike is, in fact, Cash Flow Mike. He's got a lot to bring to the table to help us as business owners as we run our businesses, and even more importantly, as we as accountants work with our clients to help them make cash flow something intentional and deliberate. I love the advice that he gave near the end of obviously having in reserve 3 to 6 months of operating expense available. That's sound advice. It's related to the current ratio as well. With that, he also had at the very beginning kind of a story on how he got into this, running so many businesses, being involved with the banking institutions. And I think that communication, just making it like he did the Shane test, being able to say, can we communicate these concepts to our clients in a useful, simple way that as business owners, they can understand? And I agree with him. Rather than percentages, let's put it in dollars and cents. What are these decisions that they're making doing to their bottom line? What's it either negatively or positively affecting their business in dollars and cents? And if we can communicate that to our clients, I think the information they're receiving from us then becomes that much more useful and helpful as they more intelligently run their business because of their interactions with us as their accounting professional, as their profit and growth expert, let's say. So with that being said, what final thought do you have, Mike?
Well, I've got to tell you, first of all, thank you for having me on. This is really thought-provoking and interesting. And I tell you, what I like about you and I, what we're doing right now is we're helping create world-class business owners and accountants who are building lifestyle-friendly businesses. Love that.
Love it. Thank you for that. Thank you. So here's what I'm going to do. Obviously, I want to encourage you as a listener, if you haven't already, to definitely go ahead and subscribe to the podcast. In doing so, you can actually set your notifications to be made aware of when we release new episodes. We do, in fact, have a new episode each and every week when I bring on guests to actually share information as to how we can, as accounting professionals, in fact, have the premier accounting firm. With that being said, I also want to invite you to look into joining us for GrowCon. GrowCon is an annual event where you can come and with your peers work on your business, learning from the experts, and more importantly, finding out what are the best practices as it relates to marketing and selling accounting services, offering quality accounting services, and even more importantly, becoming the leader you need to be. With that, also remember, if you would like more information about these principles or would like to apply these in your business, give us a phone call. You can reach us at 801-265-3777, or you can visit us online at universalaccountingschool.com. And always remember this, if it's about accounting, it is universal. Take care and be safe out there.